Hello, everyone. Hope everyone's doing well today in this pre-Eagles Super Bowl Wednesday. This is Andrew Rosen here. On behalf of David, Kyle, and myself, I'd like to welcome everyone as we have our first kickoff webinar of this year for our webinar Wednesdays. This is the first of 7. We will have one you can find on our website, all of them, but our next one will be February 14th. It'll be a market year in review and what we're seeing from our own investment specialist, Mike Horwath, like we did last year. I know people are still trickling in here, but a couple just housekeeping items before we get started. And I turn it over to our presenter, Dean Mioli, who has done events for us, and he's a tax expert, and I think speaks a very understandable level about taxes for everyone. His talk today will be somewhere between 20 and 25 minutes. We try to keep these about half hour so you can eat your lunch, listen in, get some valuable tidbits. We will email sometime today or tomorrow a follow-up of this. There will also be a survey, which we wouldn't mind you taking a quick survey just to see if you guys are getting value out of these webinars, but you will have the recording emailed to you for signing up. Feel free to share with anyone you wish, as we live to educate and help out. That said, questions. We will leave a few minutes at the end for any questions. If they're too personal in nature, obviously may be hard to answer in this forum, but we'll sift through. We'll do it in a first come, first serve. The questions can be submitted via the type in on the questions actually tab. Only we can see it, so we will ask. I will proctor that at the end for any ones that I think are relevant to a mass appeal, and then obviously anything else we're happy to assist any way we can. So with that said, let me introduce Dean Mioli, who works at SCI in their tax and practice management department. He's a good friend of ours and is diversified, and I think you'll enjoy it. So without further ado, Dean, take it away, my friend.
Thank you, Andrew. Good afternoon, everyone. Let's jump right into the presentation. And
duly noted.
We had a pretty major tax change. Now, President Trump in his State of the Union said it was the biggest ever. That's not quite true. It's probably the third biggest ever. Can you hear me? Everyone can hear me? Good? Okay. Now, one thing to keep in mind, many of the individual tax provisions are temporary and they will expire in 2025. And that's important to know because...
And we're certainly not saying we don't appreciate that, Hillary. I mean, certainly do not...
be covering the individual provisions, of course. Now, tax for the corporations was made permanent. Now, let's talk about what's not permanent and what's permanent. When it comes to tax, nothing is permanent. We could have a new administration in 4 years, and everything that was passed recently could be changed in 4 years. Taxes has historically been volatile. We've gone from high tax regimes to low tax regimes. So keep that in mind. And now that we have a low tax regime, that does open up some planning opportunities. The Affordable Care Act is on its way out. The requirement that folks have health insurance, qualify for an exemption, or pay a fine is repealed after 2018. Okay, so it does apply for 2018, but post-2018, there's no longer a requirement for folks to have health insurance. Roth conversions, and it's something we'll talk about quite extensively here because there's a lot of planning around Roths, is that if you do a conversion in 2018, so let's say you do one tomorrow, you do a Roth conversion, take a traditional IRA money, make it go to a Roth, you no longer have the ability to recharacterize that Roth conversion. It's a one-way street now. Now, keep in mind, if you did a 2017 Roth conversion, you do have until October 15th of this year, 2018, to make up your mind if you want to keep that Roth conversion or not. But going forward, that bar, that ability to recharacterize a Roth conversion is gone. So something to keep in mind. Now, with Roth conversions, one might want to look at doing Roth conversions inside their 401k plan, meaning if your 401k plan does have a Roth option, you can, within the plan, looking at the plan specifications, convert some pre-tax money to Roth money. That might make some sense. So something to look at. You don't have to necessarily just do Roth conversions with IRAs. They can also be looked at inside a 401k plan if you have a Roth 401k option. The other thing that was important to say about Roth is one of the strategies that certainly we look at when we're helping our advisors out is a term we use called Roth through the back door. And what we mean by that, and if you want further information, Andrew would be a great resource to talk to about this, essentially is making a non-deductible IRA contribution and then converting that to a Roth. Now, there are some rules around this. I'm talking at a very high level, but essentially that can sometimes be done essentially tax-free. And interestingly enough, it was specifically addressed in the Tax Cut and Jobs Act of 2017. So basically, they have approved this 100% that you can do the Roth through the backdoor strategy. So that's important to know. Okay, let's continue on. I want to talk about tax rates. There was a pretty big change in tax rates, okay? One thing that did stay the same is we have 7 tax rates in 2017 and 2018. Yes, we still have 7 tax rates, but across the board, tax rates are down, primarily for most everybody. There's a very small amount of people that would see a slight bump in their tax rate, but for 98% of Americans, your tax rate's definitely going down. Top rate went from 39.6 down to 37%. So a small bump down, but I think the people that will see the biggest tax rate decreases are going to be in the 38 and 28% brackets, and they're now going down to like 32, 24, 22% brackets. So there's going to be some significant drops down there. Now, another thing to keep in mind, there was a pretty significant revamp to the kiddie tax. And normally, just to quickly review this, when children have unearned income and they're no longer taxed at their parents' rates. Instead, they'll be potentially taxed at trust rates. And believe me, trust rates go up very fast, very quickly. So starting this year, the first $1,050 of net unearned income for a child is generally someone under age 19 or under age 24, full-time student, is tax-free. The next $1,050 is taxed at the child's rate. And then after that, so after $2,100 of unearned income, is now taxed at the ordinary and capital gain rates apply to a trust. And the top tax rate for a trust is 37%, but that starts at $12,700 of income. So that's a lot different than your parents' top tax rate, which, as on this chart, would be at, for instance, a married couple or a single person at like $500,000 or $600,000. So keep in mind that that might change your allocation in your children's accounts because you don't want to be subject to those really high trust tax rates. Okay, let's move on. Oops. Okay, just make sure I'm in the right spot here. Okay, let's talk about the alternative minimum tax a little bit. This has certainly been the bane of taxpayers for a year. We've had a dual tax system. Individuals would compute their tax return 2 ways, regular tax and alt-min. Guess what you paid? The higher of the two. Well, starting in 2018, we see that the majority of people that were in alt-min will no longer be in alt-min. This is a great thing. And the reason that's going to happen is for 2 reasons. One is the exemption amount has increased significantly for both married couples and single filers. And more importantly, the phase out of that exemption is significantly higher. As you can see, for instance, a married person, the phase out would begin at $164,100 and now it's at $1 million. So what that tells us is that there's going to be a lot less people paying alt-min. And that's a good thing. It'll be a much simpler tax filing. We won't have to get into this dual tax rate situation with Altman or regular tax. So we think this is a great thing. It's always been a problem for taxpayers, and I'm glad to see that for most people it's going to go away. Now, let's talk about the standard deduction and personal exemptions. When you file your 17 return, you see your standard deduction for a married couple and single, and of course you get personal exemptions, $41.50 per personal exemption, but it is subject to phase out. Starting in 2018, there was a major increase, almost a doubling of the standard deduction for both married and single, and there's no more personal exemptions. And what I've been seeing, and we'll talk about this more because there's been significant changes to itemized deductions, is that more people will no longer be itemizing. They will be taking the standard deduction. So what that means is that we will have a simpler tax filing, but it will change potentially how you do some things, and we'll talk about that. The computer is moving a little too slow. I'm hitting the button, but I'm not getting a slide advance here. I apologize for that. Okay, so let's talk about itemized deductions. There was a big change here with itemized deductions, and we're going to get into that. One thing that exists for your 17 return is there is potentially a phase out, meaning even though your itemized deduction is total $50,000, depending on your income level, the actual deduction you could get could go down to 40 or 35 as an example. Now that adjustment, that P's limitation has gone away for 2018. They're not really going to need it because there's been significant changes to what things you can now deduct as an itemized deduction. The big one is there's now a limit on the state and local and real estate taxes that you can deduct on your return. So a married person or a single filer, the most you can deduct is $10,000. And when you look at your itemized deduction page, which is Schedule A, that was normally the largest expense for many taxpayers was their state and local income tax, especially if they were working, and of course your real estate taxes. And now that's limited to $10,000. Now, let's say you were limited to 10, your standard deduction is $24,000. So you need another $14,000 of itemized deductions before you would even consider itemizing. Now, if you don't have a mortgage, well, how are you going to come up with another $14,000 of itemized deductions? Well, one way would be, of course, your charitable contributions could be added to that, but that would be quite a bit of charitable contributions. And the other thing that's now basically gone away with itemized deductions is your miscellaneous itemized deductions. So things like any expenses that employees would have that they would pay out of their own pocket for their job, no longer deductible. Employee business expenses are no longer deductible. What you pay your CPA to prepare your individual tax return, no longer deductible. Okay? These are big changes here. So one thing to think about is how do I make a personal expense a business expense? And I'll give you an example. If I had a Schedule C where I was a small business owner, okay, or I had rental properties, or if I had a farm, I would, for instance, move my tax preparation for my individual return from Schedule A, where I no longer can deduct it, and I would argue that that's a better place for that would be on my Schedule C, on my rental property, on my farm, where I could get a full business deduction for it. Well, that's where it should have been always, but it's definitely a better place going forward to put that deduction. And the trick is, and this is something you should be talking to your tax advisors about, is how do I change a personal expense into a business expense? Because I can deduct things for business purposes that I can no longer deduct for personal reasons. There's no, for instance, for business, there is no limit on state and local income tax, real estate tax, things of this nature. You can deduct those things, but for personal reasons you cannot, or they'll be limited. Okay, moving on. There's been no change to the qualifying dividend and long-term capital gain rate. 23.8 is the top rate. That does include the Medicare surtax, which is sticking around. The medical expense deduction, they reduced the floor for a couple of years to 7.5%, but it will kick back up to 10. And there was a talk of how one would account for the cost of securities when you sold them. But nice thing that it did not happen was that they did not take away to specifically identify tax lots when you sell securities, and we were certainly very happy at SEI about that. So that gives us a real flexibility in managing your tax bill when we're doing a tax managed implementation for you, whether it be with mutual funds, exchange traded funds, or individual securities. So we have the full breadth and depth of our tax management services at your service. Okay, moving on. Technology is a little slow. I'm hitting the button, but we're not moving forward. Okay, mortgage interest. There was a big change here with mortgage interest. Before, you could deduct up to $1 million of primary and secondary mortgage interest, and single and $500 if you were single. And home equity lines of credit, regardless of what you used the money for, was essentially deductible, up to $100,000. And I once even bought a car, and I did a home equity line of credit, and it was deductible interest. Now, 2018, that's changed. The overall limit is now $750,000 of mortgage interest for primary and secondary residents can be deductible, and HELOC, home equity lines of credit, are no longer deductible, generally speaking. And what I mean by that is you certainly couldn't go out and do a home equity line of credit and buy a car and deduct that interest. But if you were to, let's say, borrow money to redo your kitchen and you needed $50,000 for that, that would actually be qualifying under what I would call acquisition indebtedness, and that would still be deductible. So what you use the money for is critical as opposed to as being deductible or not. But certainly there's been a limit change now on mortgage interest. And again, it's not normally the biggest expense. It's usually taxes are your biggest expense on your Schedule A. There has been any change to the capital gain exclusion for primary residences. It's still $500,000 for joint filers. Like-kind exchanges, not something that most people would get involved in, but it is still around for real property. I'm sure the president was happy to see that in the tax plan. Now, 529 plans. Pretty major change here with 529 plans. Before 2017, you really could only use distributions to pay for post-secondary education, college essentially. The big change here is now you can take up to $10,000 per year per student can be used for tuition in connection with enrollment and attendance at an elementary or high school, this is huge. This is huge. I see this as a huge benefit to these 529 plans. Why? Because I know my kid is going to go to elementary school. I know my kid's going to go to high school. And I'd like to get into that money a lot sooner than college. Who knows if they're going to go to college? Okay? That is not a definite. And I have pretty bright kids. They'll probably get scholarships. I might not even need this money for college. But I know I need it for high school and elementary school. And you can now tap into that. And I think that's a great addition to 529 plans. They make them much more viable in my mind. That was one of my biggest complaints is it took so long before you could tap into the money. Now you can tap into the money as soon as you need it, which is fantastic. Absolutely fantastic. So keep that in mind. There has been a huge change to corporate taxation. One thing that has changed is that the corporate tax rate for C corporations, a C corporation, General Electric, Exxon are examples of C corporations. The tax rate went from 35 down to 21%. That's a huge reduction. And because of that, they said, well, what about the small business owner that's formed as an S corporation or an LLC or a partnership, and other types of formations to do business? Well, they put in a special 20% deduction for people in this situation. It also applies to sole proprietorships too. There's some income limitations to it. It depends on what type of business you're in. It doesn't apply to all businesses. It's actually quite complicated, but this is going to be a great time to be a CPA or a lawyer to figure all this out. But so Congress did address the small business owner, and essentially what it did is it'll reduce the top tax rate for business income from 37 down to about 28.5%. So certainly worth looking into. In fact, it may even affect what type of structure you have, whether you do an S corp or C corp or the type of business you're in. So all that's now back on the table, and potentially people might switch the entity they're in to take full advantage of the corporate tax rate or this deduction. Now, let's talk about charitable. There was a change here. There's always been a limitation on how much you can deduct in a given year for charity, and it was 50% of someone's adjusted gross income, which is a very important number in tax world, AGI, adjusted gross income. Now that's moved up to 60% of your AGI. Now, with the fact that there's been severe limitations now on itemized deductions, and many, believe it or not, most Americans did not itemize to begin with. It was over 70% of Americans did not itemize their deductions. And now with this tax law change, they're forecasting over 80% will no longer be itemizing. And so what that means is that, and certainly people are a little worried about this, is that, well, I used to deduct my charitable deductions. I used to get a write-off for that. He says, well, if you don't itemize anymore, you're not going to get a charitable deduction. So that may change how people approach charity to some extent. Well, one thing to keep in mind, and it's certainly when you're given to charity, giving appreciated securities as opposed to cash is generally a good planning idea, because why pay tax on a gain if you don't have to? You can gift away the appreciated securities to your church, synagogue, United Way, etc. And of course, when they sell it, they don't pay tax. They're tax exempt, but you still get the full deduction. The other idea is certainly for clients that are 70 and a half or older and are taking required minimum distributions. You're allowed to donate up to $100,000 of your RMD to charity. And that's a great thing, because what that does, you don't get a charitable deduction, but you may not have gotten one anyway because you didn't itemize. Two is that reduces your AGI, your adjusted gross income. You don't have to pay tax on that RMD if you give it to charity. And that's a huge tax benefit to you. It can mean lots of things. It means less of your Social Security income could be taxed. More of your medical expense would be allowed as a deduction. You wouldn't be subject to that 3.8% surtax on your investment income. It's something definitely worth looking into. Now, gift and estate, huge change here. They essentially doubled the annual gift exclusion. It went from $14,000 to $15,000. So you can give anyone in the world $15,000, and there's no gift tax associated with that. Now, the lifetime estate and gift tax exemption moved from $5.6 million per person to $11.2 million per person. So a married couple essentially could give $22.4 million away through their estate and gift and not pay a dime in estate and gift tax. That's huge. That is huge. That has really opened up some planning opportunities around gifting, because now that covers about 99.9% of Americans having a $22 million exemption. So if you have any fear about you might have to be subject to estate and gift tax, I think this has pretty much taken it away. Okay, so it doesn't mean you shouldn't be doing estate planning. In fact, it might not be a bad idea to have your estate documents reviewed at this time. Some documents happen to be very formulaic in how they're going to distribute things. And now with this much higher exemption amount, I don't want things going to the wrong places. So it's not a bad idea to have those documents reviewed every few years. And if you haven't had it reviewed every few years, it might be a good time to take a look at them. Okay. Huge change to the child tax credit. We went from $1,000 to $2,000 per child, and part of it's refundable. And of course, the phase out went up tremendously. So most Americans will get the child tax credit. We talked about the individual health care mandate, and future inflation adjustments will be much slower to happen because they're using a slightly different CPI number. Now, investment taxation is still very important. The top tax rate is still 40.8. So certain types of income are very tax sensitive. Non-qualified dividend income, short gains, interest income, you get hit with a pretty high potential tax rate. There is tax favored income, qualified dividends, long gains, and of course muni bond interest still can make sense to people. And of course, if you don't sell anything at a gain, you don't pay tax on it. Pre-tax returns rarely equal after-tax returns. Now, we do have a priority list because not all asset classes are tax efficient. Some are extremely tax efficient, some are not tax efficient at all. Doesn't mean you shouldn't own them. It's about where you own those things. Asset location. We have asset allocation, but you also have to think about asset location. Because what matters at the end of the day is what you get to put in your pocket, your after-tax returns. I don't want to pay Uncle Sam until I absolutely have to. Okay, tax deferral is very powerful. So when we're designing portfolios, we need to take into account the tax efficiency of the investments. Now, tax season is just around the corner. Everyone's going to be getting their 1099s from all their different places, and you're filling up your shoebox to go see your CPA. Here are some things I'd be asking about. One is, all right, you just did my 17 return. We have the new tax law. How do things look 18 compared to 17? Some of you will make estimated tax payments. Maybe you're no longer working and you're living off of your portfolios and pension and Social Security. How is this going to affect my estimated tax payments? Maybe your payments are going to go way down for this year. Okay, something to think about. Now, for those of you still working, the form isn't out yet, but you would probably be encouraged to file a new W-4. That is your withholding form with your employer. I think they're going to have it done at the end of February, is what I've read from the IRS. And you're going to want to fill one of those out because let's say you might be filing and you're taking 6 exemptions. With the new tax law, you may be going down to 4 exemptions or up to 8 exemptions. So it's important that that withholding number be accurate. So that could have definitely need to be looked at. By the time you see your CPA, you might actually fill that out with your CPA, the new W-4 form. Will I be able to itemize? Like I said, there's been a huge change on what you can deduct from an itemized deduction standpoint. There's a big limitation on state and local tax. There's no more miscellaneous itemized deductions. Okay, what does that mean to me? Am I now taking the standard deduction? And if that's the case, how's the best way for me to donate to charity in 2018? I still want to be charitably inclined. What vehicles should I use? What should I give? How should I give? That should be on the table. Roth conversions should always be on the table. I'm always interested in trying to do a Roth conversion. Now, with tax rates being down for most people, and historically tax rates are very volatile, I think this might be an opportunistic time to be doing Roth conversions. And again, if you had a $100,000 traditional IRA, I'm not suggesting you do $100,000. I'd certainly be looking at my tax bracket this year and say, well, how much could I do and still stay in the same tax bracket? Well, maybe that's $15,000. So maybe I do a $5,000 or $10,000 or even a $15,000 Roth conversion. Okay, I want to get the tax man paid off now, and then have access to this money for me or my rest of my life. And it's the greatest thing you could leave your kids or grandkids is a Roth IRA because they'll be tax free to them. So Roth conversions should always be on the table for discussion. And of course, if you have an existing HELOC and it wasn't for like a home renovation, buying a car, you did a trip, you might want to consider paying that off because that interest is no longer deductible. Or you might consolidate it into your regular home mortgage, which is deductible interest. Investment taxation is extremely important. It's your largest single expense. If you're in the 32% or higher federal tax bracket, muni bonds can still make sense. Asset location definitely matters. And as a regular course of our process, we do a lot of tax managed techniques. One of them is called tax loss harvesting. For instance, we had some market volatility yesterday. We had the market go down. We take advantage of those situations. We know those are temporary, but it gives us an opportunity to essentially move our portfolios around in a very tax-efficient manner. That's really what tax loss harvesting is about. Basically, we want to make gains in our portfolio, but we don't want to pay tax on them. And, of course, if your tax bill is going down, it's not a bad idea to potentially save a little bit more for retirement. And with that, I'll open it up for questions. Thank you very much.
Thank you, Dean. Educational as always. Even Kelly learned something here.
Oh, good.
So let me just say, if there's any questions, I'll give you a minute or two to type them in the questions box. Otherwise, I'll just proceed with my, again, reminding you of a couple items here for housekeeping. So again, Kelly will be sending the slides and Dean's talk here today out to you by email. Again, do what you want with it. Hopefully you listen to it many times, share it with whomever, and get value out of it. Reminding you also, these will become more regular. February 14th, get on your calendar. Mike Horwath, Kelly, is that at noon?
Yes.
Also at noon. We'll be doing a investment year in review, and it doesn't, looks like, was that what it was? Oh. And besides that, I want to thank everyone for coming and participating today. Does not look like we have any pressing questions. So feel free to reach out to any of us and we'll get them answered. Oh, wait, let's see, there is one. Dean, can you hear me?
Yes, I'm here.
All right, here's a question for you. I noticed a reduction of federal tax on my January paycheck. Should I increase my reductions?
Well, I think what I would do is we have time. It's still the beginning of the year. I think it's important that we fill out, if you're working, a new W-4 form, as I mentioned earlier, to make sure you're having the proper withholding done on your tax return. When you fill out a W-4, it's going to talk if you're married or not, if you itemize or not, and all this is in flux because you may not itemize anymore in 18. What's your new tax bracket? So that's a very specific question, but my advice is how I would handle that. The process I would use is when I meet with my tax preparer, or if you don't use a tax preparer, once you finish your tax return using TurboTax or whatever, I would definitely be completing a new W-4 and following that with my employer, and that'll give you the correct amount that you should be withholding. The idea is at the end of the year, this is how I always like to owe money. Now this is just me. When I file my taxes, I always owe. I always owe as much as I can without having a penalty. That's my goal. I don't like to give the government an interest-free loan. So you want to be within $1,000 of that number normally. So that's what I try to work my withholding to be. There's my guideline.
Right.
Okay?
Here, Dean, I got another one for you. Is there a simple formula for Roth conversions, or is this always qualitative discussion?
That's a great question. A Roth conversion is both quantitative and qualitative. I think from the quantitative standpoint, how I look at that, and I don't know if we can go back in the slides, if we can go back to the tax bracket slide. Let me see if I can get back there, is I don't want to disrupt my current tax bracket. So for instance, if I'm a single person and it's 2018 and I'm in the 24% bracket right now, which is income from 82.5 to 157.5. Let's say my taxable income for 18 is 137,500. So I could actually do a Roth conversion to for another 20,000 and still be in the 24% bracket. That would be my most I would probably do in a given tax year because I don't want to push myself into a higher tax bracket. So that's kind of my upper limit from a quantitative standpoint. Now, generally speaking, most tax brackets are coming down, so that's why I think it's a great time to be thinking about Roth conversions. Qualitative, to me, is that, hey, I would love to be able, as a financial planner, to work with clients that have multiple tax buckets. And what I mean by that, you're going to have your taxable money. You're going to have your tax deferred, which is your traditional IRA, your 401k. But you need that third bucket, which is your tax-free bucket, which is your Roth account. I mean, later in life, when you're going to be drawing upon this money for your livelihood, you're going to want to get the tax temperature right. And if all you have, and we've seen this time and time again where people have these humongous IRAs, no Roths, and a very small taxable account. You know what's going to happen there is you're going to get burned because you're not going to get the tax temperature right. Every month, every time you pull a dollar out of a traditional IRA, Uncle Sam is there for a big chunk of it. The Roth, there's no required minimum distributions. It compounds tax-free. You can draw from it later in life tax-free, and then if you leave it to your kids or grandkids, they get it tax-free. So that's the qualitative. I mean, that's real easy for me to understand. But how much I would do in a given year is I'm looking at my tax bracket. Okay?
Dean, one more question for you. We'll make this the last one because I know everyone has to get back. Seems no changes to taxing of the HSAs. Should more be invested into the stream?
I love HSAs. I absolutely. Now, not a lot of people get to do HSAs, okay, because you have to be in a certain type of medical plan. But HSAs are very flexible. I mean, for instance, there's no requirement of distributions on an HSA. In fact, once you get a little bit older in HSAs, you can even pull money out, and it's not even has to be for medical expense. I love HSAs, and if I could do an HSA, I would certainly do it, and I would say take full advantage of an HSA if I had the ability to do so.
Great, Dean. So again, I'd like to thank you for all your help, for your knowledge as always. Thank you to everyone that listened in today, and stay tuned for more. And I wish everyone a wonderful weekend and a little EAGLES for us all.
You're not going to sing Fly, Eagles, Fly?
I'll spare everyone. Bye.
All right. Take care, everyone. Goodbye.
Thanks, Dean. Bye-bye.